Hey, good morning, everyone. Happy Friday. Kevin Robinson and Colin Cass here with your morning market update. We're going to do kind of a special one here, so please stay tuned for the entire recording. So we put out a survey request earlier this week. Thank you for those that participated. We really just wanted to get your feedback on not only this market update, but also our podcast. So, of course, the number one response is consistency. We know that it's been a very busy summer. Colin and I just have to get back on putting out good content every couple weeks. So thank you for those that gave us some suggestions. And then, of course, on the market update, one of the big suggestions was record it consistently and then maybe shoot it out via email, not just text and Facebook. So be looking for some changes there. Again, anytime you have a topic you guys want us to cover, we'll get in good guests. We'll get some people in the community. Whatever you guys need, let us know. We invested quite a bit of time and money in getting this room ready, and we'd love to use it. And I think we're pretty good at it when we do it.
Yeah, we try.
Yeah, once in a while. Okay, so I brought Colin on here because this is a question that's been coming up a lot, especially this week, because the Fed meets on the 18th, and a lot of people think rates are going to drop based on what the Fed is saying.
Well, I think rates will drop. It's just what rates are going to drop, and I think that's the big misconception.
Right.
We had this issue 2 years ago when the Fed started to increase rates. Everyone thought, okay, if the Fed increased rates 0.5%, that mortgage rates went up 0.5%. And that's a big misconception. So I felt like, we should cover that.
Yeah.
Kind of go over how it works. So when the Fed adjusts their Fed rate, the Fed funds rate is how the Fed essentially loans money to the banks. And so that federal fund rate affects your short-term lending. So it affects your credit card interest rates, your auto loan interest rates, personal loan interest rates, and then your home equity line of credit interest rates. And so if the Fed decreases their rate, which we're thinking it's going to be anywhere from 1/4 to 0.5% next week, if they do decrease their rate, let's just say 0.5%, you're going to immediately see your savings account rate go down 0.5%, or whatever the bank adjusts it to. You're going to see your credit card rate go down. Your home equity line of credit rate will go down. If you're going out to buy a car, within the few days after, you'll see auto loan rates probably go down.
Yep.
But what people don't realize is the mortgage market, the mortgage rates are based on the mortgage-backed security, which is a bond. And so the way that moves is very much like a stock, and it moves before the Fed actually cuts the rate, and it moves as the Fed is talking about cutting the rate.
It's anticipation based.
It's the correct. So what I've always said is, and this is the best way I can put it in kind of layman's terms, is if Microsoft was going to file bankruptcy, you're going to see Microsoft's stock tank prior to them actually filing bankruptcy, let's say. You're not going to see a normal price on Microsoft stock, and then the day they file bankruptcy, all of a sudden that stock is going to plummet. You're going to see articles of what's going on at Microsoft, their earnings, all of that sort of thing, which is going to start driving that stock price down. And that's kind of how the mortgage market works. So when the Fed, they're going to cut rates. We already know that next week. It's just a matter of how much.
Yep.
But the mortgage rates have already moved because of all of this talk this last month.
Right.
So when the Fed actually goes to change things, we're probably not going to see much of a change in the mortgage side. We've already seen that last week, 2 weeks ago, 3 weeks ago.
Yep.
So I think that's important. You don't have to know all the ins and outs as an agent of how that works, but I think from you need to know a high-level overview. That way when your clients come to you, if they're already under contract and they went under contract last week, you're not going to go back to your lender and get 0.5% less. That's just not how it works. The rate will likely be right around the same as where they locked a week ago.
That's literally the example that I have. I had somebody yesterday call me and said, hey, my agent told me that we should probably push off closing until after the Fed meeting because I can get a better rate.
Yeah.
And I had to have that uncomfortable conversation of that's not how it works. Again, I'm not going to educate every agent like on the complete intricacies. I think Dan McQuillan's the only one that cares that much.
Correct.
But I think it's important for people out there. Don't use this as hey, it's going to be a better time because rates are going to fall next week.
Right.
I mean, we do anticipate them to fall. It's just not going to be in the increments that you see, on Fox News, CNN, whatever. Like you had mentioned with the stock. I mean, just whenever you see like a jobs report come out and I do this market update and say, okay, well, the jobs report was better than expected, rates went up. That's how we kind of react. So we do anticipate that if every quarter the Fed comes out and continues to lower, well, we should see a steady decrease. It's just not going to be in those direct increments. Like you said, you log into Huntington tomorrow and on the 19th and your savings account went from 5.25 to 5, there's your Fed rate.
Right.
So same thing as you've been talking about in the market, Colin, on refinances, there is going to be a crap ton of lenders using the Fed cut to make people believe it's time to refi.
Yep.
Like, guys, look, rates are down. Call Quicken Loans, call Rocket, whatever the heck they're called. I mean, it's going to be bad.
Yeah.
So just be out there, be in front of your clients. Again, it's positive that rates are coming down, but just know that when we wake up on the morning of the 18th and the Fed does what we think they're going to do, don't expect just you're gonna get a market update from Colin and Kevin and saying rates are 0.25% lower.
Right. And to your point, I think it's important to note, while we're in the process of protecting our clients from these just commission hungry predatory lenders, there's always a cost to refinance. No refinance is free, no matter what anybody says. There's always a cost. There's underwriting fees. There are title company fees. There are, if an appraisal is needed, there's an appraisal fee. You have to reset up your escrow account. And so they will say, well, we'll give you a free refinance. They'll take that $5,000 of closing costs and roll it back into the loan. Now their loan amount just went up $5,000. Well, guess what? Rates have not plateaued. We do anticipate they're going to continue to go down.
Yep. So
let's just say they go down another 0.5% or a full percent in the next year. Now they have to pay another $5,000 to refinance again. Now they've paid $10,000 for one refinance when they could have just waited a little bit. And the break evens just went from maybe breaking even in 3 years to now breaking even in 12 years. And they move before that time. And it just doesn't make sense. So we protect our clients, or at least we're trying to, but I know our clients are already calling us saying, hey, I got this in the mail. I got this phone call from this random out-of-state lender, and here's what they're telling me. And most of it is BS. Most of it is a bait and switch tactic for them to get them in the door. There's a local lender right now that's doing it, and he's a real turd. And I think everyone knows who he is without me saying his name. But he's already starting to do it, and he's been caught. He's been caught charging these astronomical fees, and he's been called out on it. And he's still trying to do it because that's just what he does every day of his life. But we're trying to protect our clients as the best we can, and as agents, just make sure you're doing the same. Be their trusted.
Our clients are your guys' clients too. So we're just trying to make sure that when you guys close with your client, which closes with capital, that you stay their agent and their advisor for life. And I know a lot of people are like, why would agents care about mortgages? Well, I mean, it's their biggest financial purchase, and you want to be in touch with them. Advise them on these things.
Exactly.
So, well, thanks for listening to us ramble here. Like I said, we will get back on the train with our podcast. We've got some cool things coming up. So stay tuned for that. But I will get to the market now. As alluded to, rates have kind of fallen over the last couple weeks. So your conventional 780 credit score, at least 5% down, is at 6.4. Your FHA and VA with at least 700 credit score is going to be right around 5.75. So as always, guys, we really appreciate your support. If you need anything this weekend in terms of a pre-approval or numbers, Colin, myself, Greg, and Amy, we're always available for you. Have a great weekend, and we'll talk to you again next week.
We'll see you.